Hey everyone, welcome. It is Michael with Offshore Citizen, and today I'm going to do an unusual video. We'll extract it from our normal sequence. We're trying right now to release one video a week, but because this one is timely, we want to get it out kind of right now because it's relevant to people. So I'm going to talk today about a subject that people have been messaging me about, they've been asking about actually for a number of weeks, over a month now, and that's coronavirus. Now, I haven't responded or haven't done a video on this subject because of the fact that I'm not a medical expert and I really couldn't tell you about, the broad implications in that sense. But today we're going to talk about the investing side of it, what's going on in the markets, where we're at, where we're going, and kind of fill you in because I've been getting a lot of questions about that. People were messaging me and they say, hey, should I invest in this? What are you looking at? Should I be investing now? Should I be waiting? Questions like this. So we're going to answer all that stuff from my perspective and from the perspective of this global macroeconomic picture, and then we're going to go from there, okay? So to start off with, I want to caution you that my crystal ball is always broken. Predicting the future is virtually impossible. If you were to go back to December 2019 and read people's predictions about what would happen in December or in 2020, there was no mention of this. It's broadly considered what we call a black swan event, and as a result, all kinds of stuff could happen. I'm going to try and highlight for you some of those things that could happen because they can hopefully help you to position. My approach is to try and understand the machine, okay? To try and understand the cause and effect relationships, and based on that to get an idea of what might be most effective and go from there, okay? Right now is potentially a very good opportunity. A crisis can equal an opportunity. However, timing definitely does matter. We want to be careful, etc., and go from there, okay? So going back and just putting the big picture on what it is that's been happening. We have been, basically the stock market bottomed in March 2009, all right? And so pretty much for the last 10 years, we've had an extended bull market, and there's been a few little blips in the stock market. There's been a few areas that was a little more flat. For example, 2018 was not a great year. 2019 was a fantastic year. But on the whole, we've been in this long-running bull market, okay? Now, people will sometimes say a bull market lasts 7 to 10 years. I don't really like these types of expressions because there's a famous line, bull market doesn't die of old age. And there's underlying economic drivers that change things, psychological drivers, etc., that have nothing to do with time. And so if you were to go back historically, you can see periods where things would happen more frequently and sometimes where they happen less frequently. So for example, realistically from the early 80s until 2000 was, you could argue, a pretty extended bull market. There was the flash crash of 1987, and it had a largest single percentage point drop in a day, and there was a downturn and things like this. But realistically, overall, it was still, I would say, within this broader bull market. Okay, there was a slowdown in the early 90s with the Iraq War, and there's always little blips along the way. But in the broad, what I would call macroeconomic picture, that was a long running wave, okay? Some people may disagree with me because they define it as, how long it's been before there was a 10% correction, or how long you've been without a 5% correction, and things like this. I believe we hit some records in some of those metrics this last cycle. But it can go, all kinds of different periods. Just like I was just checking the data earlier today, and if you had bought in 1966, it was basically until 1983 that you would have reached a point where you started to make money again. And similarly, you could look at something kind of comparable. If you bought at the peak of the dot-com boom, it was a long time until you kind of broke even again in around 2007, something like that. So, you have these periods where there's this trough, but if you're dollar cost averaging, you're more or less fine, okay? So we're going to talk about some of these. Now, why do I fill you in on this background? Well, because normally this cycle has these underlying drivers, and these underlying drivers go in cycles, meaning if things go up quite fast, they tend to have a correction, right? Sometimes that's a little correction downward. For example, leading up, we'd had 2017 was a great year. 2018 was not such a great year. 2019 was a great year. So realistically, when we have this rapid increase, we expect some sort of a pullback, right? That being said, in my opinion, or that's my opinion, my belief, the high probability is that this is not a simple pullback. This is not like, if you look at the charts in December 2018, there was a decline, and then that fueled a great move in 2019. Okay, that, in my opinion, this is not like that. I've had some people say, hey, this is going to pass quickly, right? We're going to have stimulus, the Fed's going to do whatever. In my opinion, no. Why is that? Because of the fact that the core drivers behind it, I'm going to talk later about kind of this, how you have the market and you have the economy. And the market is sort of an abstraction for the economy, but it's not the economy. Like the real driver outside of the economic stimulus, outside of politics and things like this, is production and consumption of real goods and services and profits behind that. So what's different now, as opposed to any time really from the 2008 financial collapse until the present, is we're seeing a significant cutback in actually both of those areas, okay? Why is that? Well, let's just take a look at, for example, the tourism industry. You have cruise ships that, the cruises are being canceled. Flights are virtually empty. Airbnb, if you go and look at the charts in terms of their revenue, it has just crashed. The numbers of cancellations at restaurants and so on and so forth are going down. That's just starting there. Then you've got, I have a lot of clients who are drop shippers and people who are doing different business in China, shipping around the world. Factories were closed for an extended period around Chinese New Year, right? So that meant there was less production during that time. At the same time, you have inflation in prices on specific items that are, not what you'd normally have, such as masks, such as hand sanitizers, things like this. You had masks that you could buy for 9 cents previously that are over $3 now, right? Like this crazy inflation in price due to disparate demand, all right? And some people, I have a business that we buy vehicles in Canada and we ship them around the world, and car sales in China are down 92%, right? Now some people would say to me, well, hang on, isn't that just something temporary that people aren't going to buy now, but they're going to buy in 4 months and it doesn't make any difference? Why it makes a difference is because during that downtime, debt payments are still coming. Operational expenses are still coming, right? You still have to pay your rent regardless of that. And this is going to have a ripple effect. Invariably, this will have a ripple effect. And what we haven't seen in the market to date, I look at, okay, so what happened basically this week? We had some carnage in the market, brutal, like one of the craziest weeks ever, which was, a little bit interesting to be a part of. We hit the largest points drop in a day in history twice in the same week, the one didn't exceed the other, but they both were above the previous high, and another one was basically at the same level as the previous high. So we had virtually 3 days out of the week that you had record point drops, okay? So pretty significant. At the end of the week, just kind of a few hours before closing, the closing bell on the stock exchange, Trump gave or actually less than a few hours, but Trump gave a press conference and they announced some things to help out with dealing with coronavirus. They're creating a national emergency and some things like this. And the market responded very favorably to that, right? We saw the market over that half hour or so that the press conference lasted, the market went up about 1,300 points. And, it turned out for the day it finished off almost 10% up, where it had been 10% down the previous day. So, it was the second biggest percentage drop after the flash crash of 1987. Okay, so that's kind of been this rocky week. And certainly if you're a technical trader, then if you had bought in this morning, that was a great buy. Just kind of for the record, right now it is March 14th, technically, but we just finished March 13th. This is after midnight, so that's the deal. So, but what hasn't happened here? So we've seen at the start of the week, okay, the impact of the Saudi oil cuts. That was, prices dropped from over $40 a barrel down to about $30 a barrel. that's going to have a big impact, right? There's going to be a bunch of people. I'm originally from Alberta in Canada. It's dependent on the oil industry. You're going to have projects that aren't going to go ahead. You're going to have people who are going to get laid off. You're going to have companies that are going to go bankrupt. You're going to, all these different things. That's going to have a ripple effect into debt markets. That's going to mean there's less consumer spending. That consumer spending is going to mean that other people don't make as much money, and so on and so forth. You want to check out kind of a general concept of this that's really well structured. I'd recommend Ray Dalio's video, How the Economic Machine Works. You can go check it out on YouTube. Great video, 30 minutes or so, fantastic. Anyway, so that's what's changed here. And if I just look, in my opinion, my belief, where we're at, we're seeing like a little bit of a correction today, and we'll probably see the market correct somewhat. But to think that we're going back to new highs is, in my opinion, probably not going to be the case. Probably not. Now, that 100% can be mistaken, and there's a bunch of things that might change that. Markets are massively manipulated by governments and central banks today, okay? So what that means is we already saw, it was Wednesday, the Fed announced they were pouring about $1.5 trillion into the market to help out repo markets, sort of overnight lending and things like this to help stimulate. The market didn't respond well to it, still crashed down, didn't seem to like that. But there will likely be more. So again, earlier we had an emergency interest rate drop of 50 basis points. We're probably going to see another interest rate drop. Some people say it'll be 75 basis points. Basically, there's a high likelihood we're going to zero, potentially negative rates for the US market, okay? So but the market's more or less already priced in that we're going to see a decrease in interest rates. So if they announce a 50 basis point drop, it's probably going to have zero effect on the market or very little effect on the market. It'll confirm what's already priced in. If they were to be super aggressive, then maybe there will be something, but you could get very easily into negative interest rate territory, okay? All right. Now, here's the thing. The market, in spite of this big drop over the last few weeks, and in particular this week, is still only at about the same level that it was in December 2018. Now, if you just think, if you think back to what things were like at the end of 2018, and compare them to what they're like today. As I sit here, I'm in Bulgaria. They've closed the schools. They're closing malls this weekend. There's a national state of emergency, I think, until April 14th. Italy has closed off all kinds of stuff. Serbia closed their borders, or a bunch of them. Austria closed borders. All over the place, they're closing schools. They're declaring states of emergency. Trump announced that they're not going to have flights coming for any travelers from Europe to America, except for Americans returning home. All over the world, you're seeing this massive clampdown, okay? Well, you've got that going on, and you compare that to December 2018. The outlook of these, to me, is just not even in the same zone, the same area. So to suggest that the market should be priced the same today as it was then seems asinine. Now, a lot of the market growth that occurred in 2019 was based on corporate buybacks of shares, okay? So now today, companies have spent a lot of money on buying back their own shares. They have less cash on the balance sheets. In a bunch of cases, they borrowed money to buy back shares, which means they're carrying more debt. And right now, debt is not a good thing, right? So in my opinion, it is highly probable that sometime in the next while, whether that's next week or next month or in the next few months, we're going to see the markets go lower. That is where I believe that we are today. And part of the reason for that is we haven't seen the impacts on quarterly earnings yet. When earnings season comes in, we're going to see devastation in a lot of different companies, okay? Maybe, big tech companies like Microsoft and Google might not be so bad, but across the board, pretty much, you're going to see a massive decline in earnings. In fact, a bunch of them are going to negative territory. And those earnings hits are going to carry all through the summer, for sure in the tourism industry. Flights, hotels, cruise ships, etc., they're going to have a brutal time. Now, with that in mind, let's talk about some specific companies that I'm looking at to give you kind of a sense of the picture of where those are. So some interesting companies to me right now are the cruise lines. Interesting stat for you. If you had bought Royal Caribbean Cruises at the bottom of the market in 2009 and held for 9 years until 2018 or whatever, over that time period, you outperformed Google, Facebook, Nvidia, Tesla, pretty much you were like neck to neck with Amazon. Pretty much the only thing that I could see that outperformed you was Netflix. Like, it was not one that anyone was talking about, but it performed incredibly well based on the price at the time. It's down to about $6 a share. It went up to about $120 a share. You're talking about 20 times growth in 9 years, all right? United Airlines, another one I'm looking at. Same thing. Actually outperformed Royal Caribbean, okay? So it was like 30 times or something insane like this. I think it was like $3, $90. I'd have to go back and check. I brought my phone with me just in case I was going to look up some things for you guys. So I'm looking for similar sort of deals. Now let's talk about why now is not a good time to buy companies like that. Royal Caribbean, there's basically three big cruise companies you might look at: Royal Caribbean, Carnival, and Norwegian, all of which are at like 5-year lows. So we like that, all right? I'm a big fan of buying things when they're down. So 5-year lows are good to me. These are in a situation where, for example, Royal Caribbean is carrying like in excess of $10 billion of debt, and they have about $200 million in cash. Their debt payments are about $400 million a year, okay? So it is very reasonable that they could default on that debt. Absolutely 100% very reasonable, because their revenue is going to be destroyed this summer. Destroyed. Like, already we've had, cruise season starting up in some areas, and ports are saying, you know what, we're not going to accept cruise ships here. We don't want to expose ourselves to coronavirus. Well, that's really, really bad, right? There's going to be some great deals if you want to go on vacation, probably. That's probably true, but for the company, it's horrible. Let's imagine what happens in that situation. Okay, you go out and you try to what are you going to do? You're going to try and raise some other capital or something, right? Because you don't have earnings to cover it. So you're like, all right, well, let's borrow some more money to finance ourselves through this gap. The problem is the cost of money is going to go way up, because there's going to be a lot of demand for money, because cash is king in this environment, right? There's a lot of deals on the market. I'm working on a deal right now. It's about 20 million euros. And I can tell you, a month ago, it was way easier to raise money than it is today. There was another deal that somebody was talking to me about over the last month. Very interesting, cool kind of technology mixed with traditional business company. But I can tell you, I had a conversation with the guy yesterday, and I said, look, like, on the terms that you want, it's just not attractive to put money into this deal. It's just not, because there's just so many deals. I can buy billion-dollar companies at 3 times earnings right now. When can you do that? And there's a good chance the market's going to go down. Now, that's trailing 12-month earnings, so earnings, like I said, are probably going to collapse. So, factor that in. But the point is, raising that capital is either going to be super expensive, which is going to hurt them for future margins going forward, or they're going to be in a situation where they simply can't raise it, right? They could go and they could issue shares, right? Dilute the shareholders. That's not going to be good, right? And whether they'll be able to sell their offering at that point, tough, right? So what's the alternative? Well, they could sell assets, right? The problem is, so they have about $30 billion in assets. They have 62 cruise ships, things like this. Okay, in theory, it's a good asset base, but who's going to buy cruise ships? All the other cruise companies are in this big problem, right? You would normally see industry consolidation, et cetera, in these times. You don't really have that ability. So to me, they've dropped a lot already. In theory, based on their earnings, they're a great buy, but I'm not buying, and I wouldn't recommend that you buy yet either, just because of the fact that they've got potentially a long ways to go. They could easily be in bankruptcy. And these are the types of things that we haven't seen, I think, fully priced into the market yet. This is why I'm saying I believe there's going to be a downturn, right? You're going to see rising unemployment, almost certainly. You're going to see defaults. You're going to see bankruptcies. These things are pretty much inevitable at this point in time. Very, very hard to mitigate those, all right? If the Federal Reserve does some stimulus, that doesn't really affect those things so much. It doesn't, you could get government bailouts. That could happen. And that's part of the thing that we're kind of watching for, right? We're watching to say, okay, what kind of government intervention will there be? Markets are massively manipulated. So in theory, if there was no government intervention, I would say the situation looks quite bad. There will be government intervention, almost 100%. And so that's going to mitigate it. What we're not sure is how much it will mitigate it, right? That's the deal. So cruise industry, quite interesting. Now, one that I think is quite interesting that is not at all threatened in that way is Booking.com. Booking.com, I'm watching them closely because, again, the tourism industry is down, but look, they're primarily digital. They're going to be in an environment where over the long term, they're fine. They're not going to be worried about high debt and low and high operating expenses and things like this that are going to sink them during this time. I'd say there's very, very low chance that anything serious happens to them long term. So it could be a chance to buy them at a steal. I'm a really, really big believer in the tourism industry long term, simply due to demographics, right? You've got already Europe is overrun by Chinese tourists, and the number of Chinese tourists is probably going to double, just due to population and income dynamics. Then you're going to have a lot of India coming on board. You're going to have a bunch of the rest of Asia coming on board. You're going to have Africa coming on board. You're going to have Latin America coming on board. The number of tourists is going to far exceed the total number, like multiples of what it is today within, however many decades. So that is a rising tide, which is going to raise the ship. So when I can invest in that space, I think it's wonderful. So United Airlines, I think, is a little bit more stable. In my opinion, first of all, Buffett has invested in the three major airlines. I think that if you have somebody like that who can come in and bail out his investments, that's very good. I think there's a reasonable chance that the government will come and bail out the cruise industries or provide some sort of a bridge or, something will happen, but it's not guaranteed. So, in the meantime, there's a possibility that uncertainty boils, and as it does, the stock price continues to crater. Okay, so we're watching. I would say that I'm not really looking to buy these cruise companies until at least for Royal Caribbean until it hits about $20 a share. Okay, so it's got a long ways to go down from there. It's at like $40 or something like that now. So it's got a bunch to go still. United Airlines, kind of similar story. I think it looks attractive. It's very interesting. American is also quite interesting. I believe I heard, didn't verify it, but that Buffett put a bunch more money into Delta right now, so kind of interesting. I've looked at a bunch of the different airlines. I don't think that the Canadian ones are nearly as attractive. To me, I believe quite highly in earnings multiples and historicals and comparables, right? So kind of looking at that from a long-term perspective. So from that standpoint, Southwest, although I like it as a company, etc., it's just not priced as attractively. And you can go through some of the others that are similar in that same area. Okay. Another area I'm looking at, the finance industry. Actually, so I follow the Canadian banks quite closely. The Canadian banks plus the American banks are quite interesting. I think European banks, not interesting, wouldn't touch them. Generally, Asian banks, less so as well. So in Canada, that gives you Bank of Montreal, CIBC, Bank of Nova Scotia, Royal Bank, TD. Actually, they all pumped really well today. Bank of Nova Scotia was up like 16%. So if I'd been a technical trader, would have been a good little bump to catch. I didn't do that, but it's they've been trading really low. So to give you some idea, normally they would trade at like 10 to 12 PE. I think if they're at 14, they're high. If they're at 8, they're super low, and some of them are down like around 7. Okay, so that's very good. If I think this is a very, very stable industry in the sense that there's 5 major players. It's basically an oligopoly. It's not really a lot of worry about competitors coming in and stealing market share, although there could be just some disruption with fintech, we'll see, but they have the ability to buy them out and things like this. So I think long-term, it's a very profitable industry. It's quite well run. There's going to be internal reinvestment. There's efficiencies. Dividends are quite high. Typically, at this point, you can get them over 5%, so you have a reasonable holding. And so, again, they've dropped quite a lot. So I'm paying quite a bit of attention to those in the States. JP Morgan, Citi, Wells Fargo, and Bank of America. So those 4. I think are all interesting. Also in that sector, Navient, which is the largest student loan company. Trump just announced that they're going to be suspending interest payments on all government-held student loans. So that's kind of interesting for an indefinite period of time during this coronavirus thing. But again, we're talking about something that's trading at like a super low multiple. So that's very, very interesting to us to see what are the options here. Another sector that I think is interesting. So some people would probably be going into the health sector or something like that. They would. I don't follow stuff well enough to have an idea that this is the best way to go. But I would pay attention to some clothing companies. In particular, two that I was looking at were Hanes and PVH. So PVH owns Calvin Klein, Michael Kors, things like this. They're quite cheap. I'm staying away from retail, although like Macy's and Nordstrom's are quite cheap. I think that's a bad area. Previously, some of the shoe companies had done well, Foot Locker and companies like this. I'm a little leery about them because of the retail aspect. I'm not bullish on retail given Amazon and things like this. And so then that comes to kind of the other ones that I think are interesting to keep an eye out for, which are some of the great kind of monopolistic tech companies. So Facebook, Google, Amazon, etc. I haven't seen them drop enough to be worth buying, in my opinion. I would pay quite a bit of attention to market cap, and if the market cap is so high that it can't, go up numerous multiples, which it basically can't. If you have $1 trillion company, it's not going 5x. It's definitely not going 10x. So you're not going to get that big boost that you could get off of, something like, a cruise company if it falls down, substantially further. Likewise with some of these airlines, etc. Oh, Six Flags theme park, that was another one. I think it's Kyle Bass was looking at it, and I think it's quite an interesting one. So these are some companies that are, in my view, worth paying attention to. Someone was asking about Zoom Communications. I think Zoom Communications is super interesting. I think it was a great buy back previously when it was half the price that it is today or whatever it was. It had a big up. Right now it's pretty expensive. It's about $30 billion market cap. I did kind of a forward-looking analysis of what their earnings would have to be over a period of time and what kind of rate of return you would get. I would say if it falls down to about a $15 billion market cap, it's probably a good buy. But right now it's too expensive, but I think it's very interesting. So those are some of these ideas. And so I'll leave you with kind of the last thing, which is some people have asked, like, what's the worst case scenario, right? I mentioned before, you've got government stimulation coming in, and that contrasted with actually what's going on the ground and what could happen. So I would say the worst scenario is very, very unlikely to happen, right? Which is the idea that this somehow results in martial law and governments taking back power and all this kind of stuff, right? I think that's pretty unlikely. On the flip side, what is potentially going to happen how much is it going to happen? We don't know, but a lot of bankruptcies, a lot of layoffs, a lot of downturn in terms of consumer spending, discretionary spending. And maybe look at the luxury brands, but they haven't dropped enough, as far as I'm concerned, to be worth being interesting yet. So these types of things could be quite serious because they can fall into this cycle, right? That could negatively affect real estate prices fairly dramatically. I talked to somebody yesterday in Las Vegas, and we were discussing a little bit. They were supposed to be buying a property tomorrow, I think it is. And so we were having a conversation about it. And yeah, you could see those kinds of declines. Some people are pretty bullish on gold. I think there's good reason to be. Likely what's going to happen is there will be some kind of stimulus, all right? And my big fear in this scenario is when you have a decrease in production combined with an increase in the supply of money, it results in inflation. Okay, so if you have a decrease in, if you have an increase in supply along with an increase in supply of money, the inflation is not so much. If you have a decrease in both, not so much deflationary wise, but when you have this disparity, that's where you have a real issue. And I think in this scenario, there's a likelihood to have a lot of money pumped into the economy. And that would be, in theory, not the biggest problem. What we had in 2008, we didn't see boom in inflation. And that was because you had all this productive capacity that could absorb it, right? But here, if you've had massive declines in production due to the shutdown of all these industries, et cetera, it could cause a big issue. And so the hedge against that is gold. And we've already seen gold has done fairly well. And I think there's some reasonable possibilities that gold will do well in the future. So I hope that helps you guys. And feel free to send out a message, request anything it is you have, like the video, subscribe to it, and I'm going to see you guys very soon.